5-month high. The flash estimate is based on around 85% of survey responses, and we will have more on that story in our market segment with Laura Foll a little later in the programme. Now, these are challenging times for UK retail, but it is not all doom and gloom, according to the property company New River REIT, which specialises in retail parks and shopping centres and whose biggest tenants include household names like Primark, Superdrug, Marks & Spencer, Boots and Next. Today, it reported underlying operating profits of £12.3 million for the 6 months to the end of September. That was down 9.5% on the same period a year ago, but it also reported occupancy levels of a record 97.7%. I've been speaking to Alan Lockhart, the chief executive.
The consumer has been way more resilient than financial markets were predicting, 12 months ago. We've seen the value of retail sales rise, so today it's about 18% above pre-pandemic levels. Of course, inflation is a driver in that, but volumes have recovered too, which means consumers are still continuing to spend, and we think that is a reflection of low levels of unemployment, job vacancies available. Consumer savings are in an excess position at the moment. And of course, wages are rising faster than inflation, and that turned this year, and I think will be a good underpin into next year in terms of rising living standards.
You also make the observation in the statement that a lot of the weaker retailers have already failed and that there's been plenty of store consolidation that's already taken place. Are you saying you don't anticipate more retail failures this winter?
Yeah, we think that the retail market, our occupational market, is in its best position for 5 years, and that's partly reflective of the consumer being more resilient. But equally, the amount of corporate restructuring has already taken place. So the weaker retailers have been removed, and the excess competition has also been removed. It is also the case that most retailers over the last 10 years have been focusing on profit and margin growth and delivering operational efficiency, including repositioning their portfolio. And you only have to look at the results that Marks & Spencer came out with about a week or so ago to show the results and the benefit of that work that's coming through.
Yeah, now your occupancy levels are at record levels,
Yep.
more or less. Is that because where leases have come up for expiry, tenants have happily rolled over, or are you attracting new tenants?
Well, we're attracting new tenants, but we have a retention rate when it comes to lease expiry or break of 98%. And what that means is that tenants are trading well in our portfolio, they're making good profits, so they choose to remain in our portfolio. So we're really benefiting from that. But I think it's also a reflection that we've got the right assets in the right locations that are aligned with the demand that we're seeing in the marketplace.
The valuation of the portfolio was off just 2% in the period.
Yeah.
That will surprise one or two people, given some of the declines in values that we've seen elsewhere in the sector.
Well, retail has been more insulated from the disruption we've seen in the real estate capital markets from higher interest rates, but that's partly reflective that retail values have already been rebased. The portfolio yield spread to the 10-year gilt is one of the highest in the commercial real estate sector, and New River's portfolio is even higher. So our current portfolio yield spread to the 10-year gilt is around 450 basis points. So on a relative basis, we're clearly outperforming.
You made one or two disposals during the period. What informed those?
Really, we'd completed our asset management strategies, and it was right to sell those. So yes, we sold 2 retail parks in Scotland for around 31 million, delivered a 16% IRR from the period we bought those back in June 2019.
It looks as though you're being quite conservative in how you're managing the balance sheet, though.
We've got one of the strongest balance sheets in the sector, and who would have thought 3 years ago that it would be a retail real estate company ending up with one of the strongest balance sheets? But we do. Our LTV is sub 30%, very low net debt to EBITDA ratio, one of the highest interest cover ratios, and we've been deliberately building up our cash position, which ended the half year at £138 million, in anticipation of being able to secure new opportunities to deliver compelling returns. So we're in a great position.
Now, obviously, the Chancellor yesterday extended business rates relief for some hospitality companies, smaller retailers. I imagine that's of no benefit to a lot of your tenants.
Well, we do have some independent retailers in our portfolio. So, we're pleased that the government has done what they did yesterday in terms of that extra relief. I think we're disappointed that the government put up the UBR rate, And if there's one thing that really aligns occupiers with owners, it's business rates. The whole industry is crying out for fundamental reform because the burden is just too great on retail and hospitality.
And did you take any comfort from what the Chancellor announced on reforms to planning rules, the fact that it is, in theory, going to be easier to obtain planning permission?
Well, the industry has been crying out for the planning system to be, speeded up, more resources to go in, and I think that will be helpful in terms of being able to drive future growth for the UK economy. So we're really welcoming, those proposals that it's going to speed up that process.
That was Alan Lockhart from New River REIT speaking to me a little earlier. I can tell you the share price has finished unchanged this afternoon at 87.5 pence. Some other news stories for you now. And the former management and owners of Wilko, along with its auditors, will be questioned next week by the Business and Trade Committee on the variety retailer's collapse in August, with the loss of more than 400 stores and 12,000 jobs. Among those to be questioned are Lisa Wilkinson, the former chair of Wilko, and Mark Jackson, Wilko's former chief executive. MPs are expected to ask about the Wilkinson family's justification for taking millions of pounds in dividends out of the firm, even when it was heavily indebted, as well as the £50 million shortfall in the company's pension scheme. Nearly 500 employees of Oxfam GB are to strike for 17 days next month in the first such action in the charity's 81-year history. The workers, who are all members of the Unite Union, voted by 83% in favour of strike action on an 82% turnout after rejecting a pay officer of £1,750 or 6% of salary, whichever was the higher. Unite said that average wages at Oxfam have been slashed by 21% in real terms since 2018, despite the charity publicly condemning real terms pay cuts by other employers. And Virgin Money has had to set aside more money than expected to cover loans it does not now expect to be repaid in full. The lender set aside £309 million for the year to the end of September. That was up from £52 million a year earlier and more than expected, which the bank said was due mainly to credit card borrowing. Virgin Money also announced a £130 million investment programme over the next 3 years to significantly upgrade its financial crime prevention and cybersecurity capabilities. Underlying full-year pre-tax profits fell by 24% to £593 million. The shares have fallen by 7%. Still to come here on Business Live. We'll have a look at how the markets have finished up this Thursday afternoon. Don't go away.
These are the creatures which are responsible for stranding Columbus in the Caribbean. They ate his boat. But the key thing here is we have an organism which does something pretty remarkable. It can convert wood into nutrient-packed protein, rich in B12, rich in micronutrients. So they taste like oysters. So they're really quite appealing, actually. But our vision is for a mass market product, really. So this is the sort of thing you put in your fish fingers and your fish cakes and that kind of thing. So we're really envisioning a big scale here. You know, if you're trying to do something sustainable, it's no good doing it and selling it to a restaurant every 2 weeks. It's got to be something which is in every single supermarket around the country to actually make a big impact on people's nutrition and health. So our vision is for large open sea farms or large urban setups for this, and for this to be put into foods that people are familiar with already.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, after a 4-year absence, HMV will tomorrow return to 363 Oxford Street in London's West End. It's where the very first HMV store was opened 102 years ago by the composer and conductor Sir Edward Elgar, in what is the earliest known example of an in-store personal appearance by a recording artist. Among those who've subsequently made personal appearances at the store include Madonna, Michael Jackson, Elton John and various members of the Beatles. Well, we can go now live to the store and speak to Doug Putman. He's HMV's owner. Doug, good to see you again. Why was it so important to you to get back at 363 Oxford Street?
Well, as you said, an iconic store. We were really sad to lose it back in 2019. Great street, lots of traffic, so we're very excited to get back on here.
You've got some special events coming up tomorrow. I think Madness are playing there.
Yeah, correct. They'll be down here doing an event, and I think that'll be great to kick it off. And I think we've got a lot more lined up. So hopefully every week we can get more people coming. We've got a whole floor dedicated to stage performance. So I think it's going to be very exciting.
What will long-term devotees of the brand notice that's different from 2019 when you moved out?
Definitely a lot more focus on vinyl. We've got an entire floor dedicated to vinyl. I would also say a lot more pop culture and band merchandise. So I think for music and video fans, there's a lot of extra product there for them to buy into.
How much does it cost you to refurbish the store?
It cost over £1 million. It was definitely not cheap, but I think well worth it.
Well worth it. What do you think footfall is going to be like, Doug? I mean, obviously, in the old days, Oxford Street used to attract a lot of tourists as well as local customers from the UK. How do you think the mix is going to be this time around?
Yeah, I mean, just spending the last, couple of days here, it's unbelievable how busy the street still is. So I think we're still going to attract tourists. We're still going to have people coming in. But because we don't have a lot of shops in London, I think we'll get a core customer coming in as well.
Well, that's encouraging to hear. I think you've got around 120 outlets up and down the country now, including FOP,
yeah.
Of course, the subsidiary. What's current trade been like?
It's actually been a good year. I think what vinyl continues to grow. Our pop culture merchandise continues to grow. The big surprise is even CD had growth this year. I think that's the first time in over a decade we've seen growth on it. So overall, we're pretty optimistic, and next 30 days really will tell the big story. But I think we're hopeful for a really strong Christmas.
CDs are up this year. What do you think's driven that? It's fascinating.
Yeah, it's really interesting. Someone made a comment to me that they figured it was because, vinyl is getting very expensive and maybe this was a more affordable way. I think also artists are putting out, more. And so a lot of fans want to buy everything that the artist does. So the album, they'll buy the CD. And so I think that's kind of helping.
To what extent do you think you're going to be able to drive a revival of Oxford Street per se? I mean, obviously, there's been a lot of commentary of late about how the street has somewhat declined. Do you think you're going to be in the sort of vanguard of turning that around?
I mean, I hope we are. I think we're in this unique position where, with city council's help and whatnot, you could bring in some pretty big bands to play. And I think that all that does help revitalize the street. There mentioned some of the people who came down and played. We've shut down this street more than a few times, and I think our hope is that we can bring enough big acts to come and shut down the street again, and I think that's going to really help revitalize the street.
Now, this is the first chance we've had to chat to you since you tried to buy some of the branches of Wilko prior to or just after its collapse. What motivated you to do that?
I think Wilko is just such a great brand. It was very endearing. The customer loved it. Obviously, I thought we had a deal, and I think the we were prepared to go forward. It was really probably the most disappointing thing in my business career to date, to not get the deal finalized in the end.
Can you give us a flavour of why the deal didn't get over the line?
Yeah, I mean, look, at the end of the day, there are a lot of parties involved, and I think the administrators were great and wanted to do a deal. We wanted to do a deal, but I think when you get into a business that's that big, there are a lot of legacy operating costs, like their computer systems and things like that, and we weren't able to convince the providers of the systems to give us a short-term deal of 3 to 4 months before we could move systems. And so when you put in the cost, it was over £1 million a week, and we needed them for probably 20 to 30 weeks. It literally just made the business impossible to save, unfortunately.
Yeah, it's a good shame. I mean, you were fairly confident that you would have been able to turn it around over time.
Yeah, I mean, look, our plans had 2 to 250 stores. I think we didn't believe that it needed to be sold for the pieces. We thought we could save close to 10,000 jobs. No doubt that we could have turned it around. I think the public loved Wilco, and I think they would have come and supported us if we had made it happen.
Okay, so before I let you go, which madness tune are you looking forward to hearing most tomorrow?
Look, I think I'm just happy to meet them, to be honest. I think it's just kind of really cool to get a chance. I don't get a chance to be in London too often, 3 or 4 times a year, but to actually get to meet, the band, I think is pretty fantastic and exciting. So I'll just be happy to get a couple autographs, hopefully signed to me, and have it on the wall.
Brilliant stuff. Doug, have a great day. Best of luck with the reopening. Thank you.
Thanks so much.
Night boat to Cairo, I think, is one that I'd have wanted to have heard if I'd been there. Anyway, the sell-off in the oil price has gathered pace as the session has gone on after the decision of the OPEC Plus cartel to postpone a weekend meeting, raising hopes that the group may cut production by less than expected. Barrel of Brent crude currently changing hands at $80.95 a barrel. That's off 1.25% on the session. Well, European stocks have finished the session all in positive territory. Look at that. It's largely on optimism over the weaker oil price, I think. The AEX in Amsterdam, which isn't on the screen there, that is up very slightly on the Dutch election result. The leading gainer in Amsterdam this afternoon, BE Semiconductor, which is ahead by 2%. The biggest faller is Heineken, which is off 1%. Well, here in London, the FTSE 100 is up 1/5 of 1% just now. Mixed trading, it's fair to say. There's almost as many fallers as there are gainers right now. The leading blue chip gainer in percentage terms is Intertek. The testing and safety standards group is ahead by some 3.5% or so on a trading update. To the downside, a number of stocks have gone ex-dividend today. In other words, they're trading for the first time without rights to the latest payouts. They include Vodafone, Imperial Brands and National Grid, all very popular stocks. If you own any of those, don't worry about the falls there. That is all because they've gone ex-div today. Outside the FTSE, the North Sea oil explorer Ithaca Energy is ahead by 9%. It received a push from one of the brokers today, while the consumer goods group PZ Cussons is up nearly 3.75% on a trading update. Wall Street, of course, closed for the Thanksgiving holiday. On the FX markets, well, the pound has reacted positively to that flash PMI data I was talking about a little earlier. Sterling ahead by nearly 1/3 of 1% against the greenback. It's up by around 1/6 of 1% against the euro. The single currency up by 1/7 or so of 1% against the dollar. Well, joining me this afternoon is Laura Fold, Portfolio Manager at Janus Henderson Investors. Laura, great to see you again.
Thanks for having me.
Let's start with the PMI data. Were you surprised to see this sort of uptick in activity?
I was modestly surprised. I think what we're seeing is that the UK economy is generally performing better than expected this year. If we think back to this time last year, the consensus was that we'd be in recession at this point. We had the IMF coming out and forecasting quite a steep recession, same for the Bank of England. We're here and we're looking like 2023 will be modest growth. 0.4% is the current consensus GDP growth for this year. Now, you'll remember that in the third quarter, the economy flatlined. So we're not talking about stellar growth here. Nevertheless, it's positive to have what looks like the services sector back in very, very modest expansion. Remember that services are roughly 80% of the UK economy. So it's really that services sector that matters for the overall health of the UK.
Indeed so. I mean, I've seen it said from one or two commentators that the relationship between the PMI data and GDP isn't as close as it used to be. Would that concern you? This may not tell the whole story, obviously.
What you've always got to be aware of with PMI data is that it's survey data. So, take it with a pinch of salt. But the reason we use it is that there is a problem with GDP data and also labour market data in that it's quite backward looking. What we really want to know is what the economy is doing right now, not what it's done last quarter or the previous quarter. So that's why, even though the accuracy can sometimes be not fantastic from this PMI data, we still use it because it's the best we have.
Absolutely. Now, I mean, on that point, we had the OBR forecast yesterday in the autumn statement. One of the things that struck me, which hasn't had a lot of attention, is the OBR seems there's a bit of a variance opening up between them and the Bank of England. The bank seem very, very much more pessimistic than the OBR.
So what you've got to be aware of with these OBR forecasts is a couple of things. Firstly, they did bring down their forecast for 24 in terms of GDP growth, and that is getting a lot of attention. But you've got to be aware that them saying the economy will grow 0.7% next year is really only getting to where other forecasters were already. In that, if you look at consensus in the market, we were thinking around 0.4% GDP growth for next year. So from a market perspective, when I saw the numbers yesterday, I thought, yes, OK, we're kind of there, to be honest. The other thing to be aware of with it, and this is slightly nuanced, so bear with me, is that the UK economy is bigger than we thought it was at the beginning of the year. So you might remember that the ONS came out in summer and said, actually, the UK economy recovered really well following the pandemic, better than we thought. So we're starting from an economy that's bigger, and therefore, actually, 0.7% growth next year isn't too bad because we're starting from a bigger pie. So there's various nuances to it, but it wasn't too much of a surprise yesterday.
I mean, in terms of your individual corner of the market, I mean, obviously, we've got some measures to push pension investment into more unlisted businesses and sort of VC-type backed businesses. There wasn't much for the sort of quoted companies sector, was there?
I think that's fair. There had been a bit of momentum building in the press around this idea of a British ISA. So the idea being you divert British savers towards UK-listed equities, and you can debate how you strike that, whether it's small and medium-sized companies, whether it goes all the way up to the FTSE 100. You have to be a bit careful with the nuances. But there had been seemingly a bit of momentum building behind it. So I think it's fair to say that there was a bit of disappointment in the industry around the lack of announcement yesterday. Now, just to give you a bit of context, because I think it's important, if you look at other countries, most countries, they support their domestic equity industry. So, for example, the Australian superannuation funds invest heavily in domestic Australian equities. We lack that equivalent here in the UK. And what that means is we're quite at the whims of sentiment to foreign investors. So if something like Brexit happens, it can expose underlying fragility in the UK equity market. So that's why, as an industry, we're looking for this more domestic support base for the equity market.
Yeah, and also worth pointing out, we still have stamp duty on share dealings for a lot of investors that pushes up the cost of capital for businesses. You know, the Germans have more or less abolished it, I think.
So that was another measure that was being touted. There were quite a few measures, you know, whether it's something around CGT, inheritance tax being extended beyond AIM. You know, there's lots of different measures that you could use to try and just tweak attention towards the UK equity market. And it's fair to say there weren't any material measures for that announced yesterday. So there was just that slight disappointment, I would say.
Maybe we get another chance in the spring. Laura, good to see you again. Thank you. Well, that's it from me. I'm back again tomorrow morning at 11:30 with our next edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up next, it's Mark Austin with the News Hour, and we are expecting a news conference with the Irish police following this serious incident in Dublin city centre, on which we have been reporting all afternoon. Do stay tuned for that. See you tomorrow. Thanks for joining me today. Cheerio.
The five of us have made it out of the car.